according to our models, is this conditional expectation. If you change something of my information set, I update this expectation accordingly. Okay. So the question is very simple. What is the maximum price that this individual will rationally pay for something that pays a random positive amount one period later? The maximum price that this person is willing to pay is the price. We may say the maximum price that a buyer is willing to pay, the minimum price that a seller is asking for, maximum and minimum have this intersection at that point that will be the equilibrium point. Alright? So what is the price of this claim? That's the question. Alright, so we have expected utility. Question would be, according to which preferences? We have discussed three types of preferences, three types of utility function, and hence three types of expected utility function that inherits. Each of one inherits the nature of the utility function. If you deal with a guy with linear utility function, with a risk neutral, the expected utility function is going to be linear. If we deal with a guy with utility that is concave, so with a risk adverse guy, the expected utility function is going to be concave, and a risk lower we have utility function characterized by a convex function, and then the expected utility will be convex as well. We discussed that. The expected utility inherits the main features of the base utility function underlying. So I'm going to make my analysis with the relevant idea. I'm going to put it in very general terms, but because I would like to make a kind of graphical analysis, I'm going to stick to the representative area, the risk adverse. We have an individual here, and in the slides we have that the individual has initial wealth. Initial wealth is omega t. This is playing no relevant role in this analysis. So I'm going to simplify that. In the slide is everything represented with omega t. I'm going to simplify things. I'm going to make things easier by simply assuming that that guy is poor, has no wealth at all. We remove one of the features of freedom. Plays no critical role. We know that in reality interferes. You have little wealth, you are going to be more risk tolerant than someone who is filthy rich. Yeah, okay, but other than that, the analysis is the same. Okay?
Antonio, could we raise the
Sure.
little?
Yeah.
It's exactly.
You tell me. How much is feels comfortable?
So the air can enter.
Yeah, it's not like a, it's not making the reflection. Is it? Can you see, because here is it the...
Can you write something on that part of the board?
I think it will be fine. It will be
To check.
So...
Yeah, you can see it.
Looks okay?
Can you see? Put a smile.
No.
Sorry,
No.
sorry, Mr. But
I can't.
You can see?
A little bit.
you can, right? Sorry, listen. It's a matter, I'm sorry, it's a matter of priority. And seeing the black hole is top priority.
Okay, no worries, just an
It's
hour.
very nice. And it's true, it feels very different from, it's just a matter of anger, and it looks completely.
It's a matter of preference.
No, not really preference. It's a matter of whether you can see or not the
But if we can turn on the light, I think the thing's gonna be better. Okay. Fine.
Okay, guys, let's ready. I need just a little piece before I start. And it's this price, this random payoff. I need to do something with it in order to make my analysis much more clear. Alright, so let's think that xt plus 1, the random payoff, is something like it pays, let's say, 4,000 and 10,000. It must be positive, right? It's a random variable. And this is going to happen with probably a half and a half. Right? That's the probabilities. Random, 50% of the time you get 4,000, 50% of the time you get 10,000. If you're lucky, you would like to be here, but you may be there. And there is no risk of loss. This is something that today must have a positive value because it's an asset in the sense that it gives you something for sure, only that you don't know how much. Alright? So this is my random variable we're gonna play with. I need to do a different characterization. And the characterization that I'm gonna do exploits something which is called, in a very fancy way, it's called orthogonal decomposition. Looks super ugly, right? See what I'm gonna do. I have a random variable, let's call it y, like that one. Okay? A random variable. So what I'm gonna write is this thing. Y equals y. Tautological. Nothing here, right? Now, I'm gonna call mu expected value. I'm gonna do it with expectations. I'm gonna do it fully transparent. This is right. Then this must be right as well, right?
Yeah.
No, that's right. So if this is right, this can be written as what you expect from y, the expected value of y, plus something that I'm going to call epsilon. And of course, that epsilon is going to be y minus the expected value of y. And you see how I'm using this transformation. I'm taking this expectation, and what is left is y minus expected value of y. I call that, I pack that in expected, in epsilon. So what I do is say y is what you expect to get plus something which is a shock, an unexpected component that has this property. The expectation of this epsilon is the expectation of y minus the expected value of y, and that's 0. So this is what we have called previously in this course how? 0, having 0 mean is
Anonymous.
no. This epsilon is called in the context that we have described over the previous weeks.
An exogenous shock?
No, it's a shock, but also called with 0 mean. No, random shock or fair game.
What?
No, it's not a fair game, that epsilon. We say a fair game or a shock is a variable that has 0 mean. That's it. This epsilon here in this characterization is a fair game. Something that this adverse individual dislikes. So embedded in this random game, of course, because of the randomness, there is something that the agent is going to dislike, that epsilon. Is this clear? This is what you see with this, you have seen this thing, right, exactly this thing in a different context, in econometrics. You have written y equals alpha plus xb plus epsilon. This is the expectation of y given x. And epsilon is the expectation of, and epsilon is the shock. This is called the orthogonal decomposition. This epsilon has 0 mean and is uncorrelated with the x. When you have this model, which is a canonical model in econometrics, you can estimate consistently those parameters that characterize the mean. I'm building on this decomposition. And in the polar, it's very simple. I'm saying your result is what you expect on average plus deviations with 0 mean. So look at our game. It was the original variable, the original game, right? The original random variable is 4,000 and 10,000. Probabilities are a half and a half. So that makes the expectation of xp plus 1 how much?
1/2 times 4,000 plus 1/2 times 10,000.
So
So he's 7,000.
it's like the CPIU making the noise like 7,000. So I can say xp plus 1 is your 7,000, that is what you expect, plus epsilon, and epsilon must be another random variable capturing, I'm going to use the same notation, right? This epsilon t plus 1 must be the values that capture the departure from what you expected. You expect 7,000. But 4,000 is what you will come up, what you realize in this point. So the shock is how much?
Minus 3,000.
Minus 3,000. You expected 7,000, but you find 4,000. That means a shock or minus 3,000 with probability a half. And here, you expected 7,000, but you end up with 10,000, so the shock is the surprise
Plus 3,000.
plus 3,000.
So it's symmetrical shock.
Because it has zero, it's not symmetric, it has zero mean, it's not, this is a particular case of what you are thinking. Symmetry is a particular case of a distribution centered at zero. But you may have something centered at zero that is not symmetric. I'm not saying anything about symmetry. Symmetry is the skewness coefficient. I'm saying something around the mean. In this particular case, indeed, you have a asymmetric distribution. But the important feature that I'm sort of emphasizing is zero mean. You can see this game in this double characterization. Either I expect 4,000 and 10,000 with probability a half and half, but this is equivalent to get 7,000 plus a shock that would be around minus 3,000 or 3,000 with probabilities a half. And I like the representation better because it helps me to take advantage of the graphical representation that I used the other day working with random shocks, with fair games. We know that people dislike the fair game. So I'm going to take advantage of the representation. This game can be characterized analytically as the expectation, as the expected value, plus some shock that you will observe. All right, so over here we have wealth, and over here we have utility on wealth. Same thing that we characterized the other day. And now I have a utility function. We may have three types of utility functions. I'm going to speak to the one that corresponds to the Ricard graph. Concave, increasing, always increasing, but concave. Forget about the initial wealth. My point is, characterize the impact. We have this guy right now, he's happy, he has little utility, right? It's utility function, but we are not shock it next year. Next year, we are gonna give it 4,000 with probability 50% or 10,000 with probability 50%. Or we are gonna give it 7,000 plus that surprise. So what he expects is the expected value of xt plus 1, right? That's the expectation. Sometimes I get 4,000, sometimes I get 10,000. On average, I will get something around 10,000. We'll go up all the way. This point here is unattainable. This point here is the utility evaluated at the expected value of the payload. If this guy was given the expected value, so the 7,000, for sure, granted, he will get all this much utility. But he's not gonna be given 7,000. He's gonna be 7,000 on average. So that level, that high is unattainable. He will not reach that much. Instead of that, he moves symmetrically, right, as we said, around that level. Minus 3,000 below, 3,000 above, right? So let's call it A and B, right? This is going to be like the expected value of xt plus 1 minus, I don't know, the C, this amount. Let's call it C, right? That's 3,000. Let's call it C. So down there, he will get expected value minus C. And if he picks this value, this is the utility that he's gonna get. If this is what happens, and that will happen with 50% chance, he's gonna get this much. So this is going to be a utility evaluated at the expected value of xt plus 1 minus this, right? If things are okay for him, if he's lucky, he goes up to this point, and that point is the expected value of xt plus 1. Let's call it plus c, right? You get the other bound, plus c. And then if you are lucky, then you get all this utility, all this value, which is up here, and that's the symmetric point, right? That will be the utility evaluated at the expectation of xt plus 1 plus c. You get more wealth, you get more utility. The problem is that all this stuff must be in expected terms. This thing is going to be in expected terms because 50% of the time this is gonna happen really to him. 50% of the time this is going to happen really to him. So now I'm going to use the same trick, the same graphical trick that we discussed last week. I join these 2 points with a chord, with a line. Right? Here in the intersection, right, with the axis, with the point that we are getting, we take the value all that way. This is the expected utility of the gain. This is what he expects to find. And I can represent graphically taking this type of linearization around that point. Alright? That's what we did last day. I'm finding here if this value was given for sure, he could get this much utility. But because this is not a certain amount, but expectation, then he loses all this much. It's not the value, this is not the utility evaluated at the average, this is the expected of the utility. And the concavity is what makes this difference. If we have this neutral guy, those 2 points will be the same. The concavity of the function, the nonlinearity here, makes this curve to departure from this line here. That will be the Riesz neutral guy. So we get this difference that we are already familiar with. The expected utility for a Riesz-Albert guy is smaller than the utility of the expected price.
So again, one more time, what is the point, the line that you just draw? Can you explain one more time?
I link the utility at the lower point to the utility at the upper point.
Yep.
So the intersection point, this level here, is going to be t times the utility when we get the point A, right, when you are going down, plus 1 minus p, the utility of the upper point. So it's the weighted average, the expected utility. Remember when we first introduced concavity, we use that thing, right? A concavity function is one for which lambda f of the point plus 1 minus lambda blah 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 was smaller than f of lambda, the middle point, plus 1 minus lambda of the other point. So this is what we are constructing here. The function evaluated at the average is greater than the average of the functions, because it was concavity creates. Because this guy has a concave utility function, this gap appears, as we explained. So far, everything's exactly the same. Now, the new thing in this class, in this level of utility, right? This is the utility that he has. At this point, we go down. This level, I'm gonna call it xt plus 1 star. What we observe is that the utility of xt plus 1 star is the same as the expected utility of playing the game, right? If this guy is going to give you this asset and this payoff next year, he's going to experience a certain amount of happiness. That amount of happiness is the same as if this guy was given an amount which we call XP plus 1 star. And this is the critical point that's the most important thing to me at this point in this class. This is gonna help me to say something. It's already clear, guys? The difference between the 2 points in the dollar, the difference between the 2 points, this distance here, is the Pratt's risk premium. But to me, it's not so important. Actually, I'm not gonna stick to the risk premium definition. We are moving to the new definition very soon. So I don't want you to be very confused about Pratt's risk premium. To me, what is very important is this XP plus 1 star that has a name. Which was the name of this guy? The certainty equivalent. This is the certainty equivalent of this payoff to the individual given these preferences. And now we can say something very insightful given the graph. How is the certainty equivalent in relation to the expectation of the game? How is bigger, equal, or smaller?
Smaller.
Smaller. So here comes a sort of critical point. The type of graph that we can make there defines 3 types of gradient depending on the utility function. And what's going to happen is the following. If the certainty equivalent is strictly smaller than the expected value of the payoff, and this is exactly what happens there, then you are going to observe a risk premium that is positive, and this is the effect that we link to risk aversion.
They use a different color.
What? No, you don't see that.
No, I don't see anything.
Sorry.
No ven con la ventana abierta, no ven con lo rojo.
Okay.
Que somos daltónicos.
Yeah. So what I was saying is, if the amount is XP plus star, which is the certainty equivalent, is smaller than the expected value of the payoff, this happens when the risk premium is positive. This happens when we have risk aversion. If XP plus 1 star equals exactly the expected value of the payoff, this happens because the risk premium is going to be equal to 0, and that's what happens for the risk neutral guy. For the risk neutral regime. So risk aversion would be the function that we have calculated right now. For this other guy, we have risk neutral, and this is what the graphical will look like. And then the third scenario is when XP plus 1 star is greater than the expected value of the game. And this is going to happen because the risk premium will, of course, you take the other, you put that line in the other side, we revert the sign of the risk premium, we switch the direction of the risk premium, then we understand that the risk premium is negative, and that's what happens to a risk law. So there are just 3 types of people, and we identify those class of people depending on this question. There is this game, and there is this price. It pays you 4,000 or 10,000, with probability 50%. So you should expect 7,000. Now, if instead of gambling, I give you a fixed amount, how much would you accept? How much you will demand? Jesus.
XP plus 1 is.
No, numbers.
Numbers.
You understood the dynamics of the game. How much will you sort of be willing to take in order to remove the randomness? You will not ask me less than 4,000. You have 4,000 for sure. And you cannot ask more than 10,000 because this game will not give you more than 10,000 in any scenario. But something between 4,000 and 10,000 is what you are going to ask for sure. depending on your preferences. Now, depending on whether that value is false when compared to 7,000, you will be set one of these three classes. How much you will it? 4,000 or 10,000? Will be 6,000 okay? Granted, no chances, no coin flipping. Will you take 6,000?
Yeah, we think 6,000.
Risk adverse. Ignacio, how much you will take? How much you will take?
Similar.
7,000 is the average.
Yeah, I'll take a little bit less than 7,000, like 6,500.
6,500. So we learn something from Ignacio when compared to Jesus. They both are risk adverse. But the preference of Ignacio make him feel less risk adverse than Jesus. So Jean,
I think in this case, I don't care. I'm okay with 4,000.
you will go for, you cannot make less than 4,000. 4,000 is the very minimum that you will get with the game. Imagine that I say, I want to swap this game for a certain amount of money. I give you an amount, so you don't have to care whether it can be 4,000 or 10,000. That means that you will never get less than 4,000 in any scenario, and you will never get more than 10,000. So if you want me to give you some amount for certain, it cannot be less than 4,000. You will go down up to 4,000?
No.
No, how much then? This is very personal. There is no, guys, there is no right question or wrong question. There is no right answer. It's just how you feel, how you will feel about that.
6,000.
6,000, like a Jesus. You see that, guys? So 3 risk adverse guys, but each one having a different preference. Is this okay? It's understood. Because now we move into the final part of my analysis, which is valuing this game. We have what we need. So first approach, we can identify how much they are willing to accept for swapping this change, for swapping this game. This is the certainty amount. There is no uncertainty next year. So we can take a first approach, which is called the certainty. I got it. So the first valuation approach is called the certainty equivalent approach. The price today of something that pays xt plus 1 next year is equal to, if you are able to identify the certainty equivalent, we can take advantage of that knowledge, because this is the amount that for you is indifferent. It gives you exactly the same amount of happiness. So you have managed to remove the uncertainty by just changing the value, xt plus 1. And because this guy is free of any uncertainty, we will discount it with the rate that we use for risk-free operations. 1 plus risk-free. This is the fair value, the intrinsic value, the theoretical value of this amount. Do we agree? This has a problem, and this problem is we need to identify this thing at the market level. Some people, we have 3 guys here, someone said 4,000, someone said 6,000, someone said a little bit more, someone said 6,000. Let's see that collectively we finally manage a kind of common amount. That would be the amount, the certainty equivalent market-wide. That would be the one that sort of emerges. This problem here is that this is just a theoretical benchmark. We will not use this because we cannot consent to it. I cannot go to everyone in the market and make this question. I can go, how much will you accept? I don't know. Some people will say, I don't know. How can you expect me to quantify exactly? Now, I cannot do it, but at the theoretical level, I can identify this object. This is a theoretical reference for us. This object exists. I cannot observe it, but exists. And that gives me the reference. I could theoretically value anything by discounting the certainty equivalent that it has with the risk-free rate. I'm not gonna do that. All right, I cannot do that because it's not feasible. Then what? What is feasible in this analysis? What is feasible in analysis is not working with the certainty equivalent. What it was feasible is to naturally work with your expectations. You identify this game, it's uncertain, it's random, but you clearly agree that the expected value is 7,000, and all of us would agree that it's 7,000. So this natural expectation is the thing that goes into the numerator. We are going to discount the expectation, which is a natural thing to perceive. You expect this amount to get, right? All right, let's start there. Now, that numerator is not the same as that numerator to the left, because as we said, depends on the preferences. So for the general context, the realistic context in that we have risk aversion, this guy is greater than this guy here. So this equality sign will never be attained. If you discount with 1 plus the risk-free rate, you will never match this equality. If you have a bigger numerator, you need to have a bigger denominator. So we need to plug here something which matches theoretically this difference, that corrects this difference. This amount that I'm going to put here, this guy is the risk premium. Then nobody is risk premium. So notice the difference. In the graph, the Pratt's risk premium expressed in dollars, in euros, that's euro value. And that's the primitive version of the risk premium. Right now, we have a different thing, which is more accurate, which is more sort of appropriate in the context in that we work. And this is the risk premium expressed as a excess of return, as a rate of return. And this is the meaning that I'm going to use in the rest of the remainder of the course. We are going to work with the risk premium understood as a excess of return over the risk-free rate. Now, this risk premium has a relationship with those amounts. We say, for this adverse individual, the certainty equivalent is smaller than average, than expected value. So the risk premium is going to be how? Positive, 0, or negative?
It's positive.
It's positive. People will demand a higher risk premium when confronted with higher uncertainty in the payoff. Investments with greater risk, with greater uncertainty, will make you discount at a higher rate. The risk neutral individual, in the risk neutral world, the expectation will match the certainty equivalent, then we will have a 0 risk premium, and we can discount at the risk-free rate. And this is a characteristic which is going to be super distinctive. And that's why we call the next approach, we are calling it the risk-neutral approach. When you are entitled to discount at the risk-free rate. And there will be the last case for risk lovers, that risk premium will be negative. Those guys are willing to pay rather than demanding an amount when confronted with risk. These guys don't mind to pay for a fee when going into the roller coaster. They are happy, but they are not the most of us. Most of us are the risk averse guy. So we will observe risk premium when we observe collective investments. If I analyze the financial market, I should be able to observe the evidence of the risk aversion reflected in positive differentials of risk. I will observe more risky investments having excess of returns over the risk rate greater when the risk is greater. Okay? This is our favorite approach. This guy is our favorite approach. This is the one that we use the most. This is called the risk-adjusted approach. And notice the difference, the methodological difference. In the certainty approach, in the certainty equivalent approach, we adjusted the cash flow and then we discount with the risk-free rate. Why? Because this amount is in the future. Because the amount has been discounted, because the amount has been corrected to remove risk. We only need to care about time passing. You just have something in the future that you need to bring today. But that thing is certain, so you only care about time. Here, the approach is different. We work with something that is the expected value, so risk is still here. You are promised 7,000, but you will find yourself with 4,000 or 10,000. 7,000 on average. Not exactly 7,000, 7,000 on average. 7,000 expected. So you have risk. Now, because this has to be adjusted, the rate of return that we use to discount has two sources, has to do two jobs. One is correcting for time passing, and that's RF, and another is correcting for risk, and that's what the risk-free rate, that's what the premium does. Okay, so we are adjusting the flow here, and we are adjusting the rate at which we discount this approach. This is our favorite one, and you're going to see that in corporate finance. All corporate finance and valuation is based on this approach. Give me the risk-free rate. Give me the premium. The risk-free rate is something that we will observe from the market. It's common to all individuals, so that's not going to be a problem. But the problem is how to determine this market weight amount. So pricing an asset, determining the price of an asset, and determining the risk premium is the same operation in reality. How much premium do I need to charge in order to discount is the same question than determining the value of an asset. So when we say asset pricing, we refer to prices, of course, but you're going to see most of the time asset pricing being referred to what is the rate of return that you should charge to certain operations, determine the discounting factor. So that's what we do in corporate finance and valuation. And there is a third approach, which was the most esoteric one, remember, that we call it the risk neutral approach. These two things, I hope, is transparent before jumping to the most kind of exotic one. These two are okay, right? Now we go to the third one. In order to jump to the third one, let me emphasize the difference here. This expectation is made out of the physical probabilities, the real probabilities. I suppress that notation because it's not necessary, but in order to make my point clear here, I'm going to resort to this notation. This expectation has been computed based on the physical probabilities in which you expect things to happen. You told me 4,000 with 50% chance, 10,000 with 50% chance. So that's how this expectation has been created. P times 4,000 plus 1 minus P, 6,000. Sorry, 10,000. And that is the 7,000. Now, in the last approach, we're gonna adjust not the cash flow like here. It was adjusting the cash flow, not the rate of return that we used to discount. That was what characterized this approach. Instead of adjusting this thing or this thing, we adjust the probabilities. This is the most esoteric thing. We are going to compute different expectations under different probabilities. Those are not the real probabilities, so that's why things look so exotic and somewhat weird. Those are not things how we're going to change. It's a different set of probabilities that we call equivalent measure. And when we compute the expected value of a payoff under this probability measure, essentially we obtain the equivalent of the security equivalent. We know that individuals are not risk neutral, but we can transform the problem and move into a kind of parallel world in which we can do the evaluation as if individuals were risk neutral. And in that world, we have discussed that the proper discounted factor will be the risk-free base. Is clear?
Can you say one more time again?
I'm gonna give you, because these things, I think that we see it more clearly when we put in numbers. But before jumping into that, let me describe the strategy. 3 evaluation approaches. The first one, theoretically, pure benchmark. This is my reference, my theoretical reference, and I'm moving around it. I will not go into that direction. We use the natural expectation, which is of course the natural thing to do. All right, because these things are different, you will need to correct using a different discounted factor. But that has a part in it, that has a price. You want to work with expectation of 7,000, you will have to look for the proper risk factor, the proper discounted factor, which is greater than the 3% that we mentioned before for the risk free. So that's a problem. And we'll say, what is this delta? And that's a new matter of discussion. We will see that in chapter 2. Why CAPM? Why FAMA French? Because they give you the delta that you need. And those are market driven. This is like the information that I can look and get from the market. And now we go into the most exotic thing. It should be enough, but in certain contexts, it is much more advantageous to avoid the problem of the delta. And I cannot go to the certainty equivalent. So what if I could figure out the certainty equivalent without asking the people, what do you think, how much would you accept in order to change this asset for a certain amount that is going to be, granted? How if I would change that, and that could be reflected in a different probability Q that makes the expectation matching numerically that certainty equivalent. If you were able to do that, then you could discount, because the base numerator is the same as this numerator, then you could discount at the risk-free rate. And that's more convenient, because the risk-free rate is something that I can observe directly. So let me go back to putting numbers here, right? The P measure. The P measure was 4,000, 10,000, and P measure was 50%, 50%. So the expected value of the payoff under the P measure, was 7,000, right? Now I want to change this measure. This is the word that we use. I want to change the measure to look for something different. I asked Jesus before, and he told me my certainty equivalent is 6,000. So this is the thing that I want to match. He said 6,000. And he wants 6,000 to be equal to the expectation of XP plus 1. And that's impossible if you work with the original probabilities, because the original probabilities make the expectation 7,000. So what if we change those probabilities? All right, there is no way to compute that expectation based on the 50-50. But what if instead of using P a half, I use certain Q that is multiplying 4,000 and 1 minus Q, right? The other probability will be multiplying the 10,000. That makes
Q 1/3.
2/3. Good?
Yeah, 2/3.
2/3.
That's how risk averse I am.
According to your degree of risk aversion, there is an expectation. You see, I'm not changing anything. The payoff, the expected payoff, it's still 7,000. But you told me, you revealed me your preferences. You told me, I am a risk averse guy. I will demand 6,000. So I can twist the probabilities and find something that makes the expected value equal to your 6,000.
That Q would be like an interpretation of how risk averse I am. If it's close.
It is related to your degree of risk aversion. But the point is, if I compute the expectation with 2/3 rather than with 1/2, then I get the certainty equivalent. So this expectation computed with this Q measure can be discounted with the risk-free rate, and we will get exactly the same valuation. Is that a bit more clear now, guys, how this works? I have used an argument, an external argument. I have used some sort of external information in order to give more information to my model using this values, I have taken those, I have redefined the probabilities, and I have done the same job. Of course, you will tell me, but if you knew from the very beginning that the certainty equivalent is 6,000, why the hell you do all this stuff? The point is, what if I don't know the certainty equivalent, but I could be able to figure out through some type of operation? And this operation is something embedded in the computation of these neutral probabilities. Then I end up in the certainty equivalent, which I can discount with the risk-free rate. If I knew from the very beginning the certainty equivalent, the job is done. I discount with the risk-free rate, end of the story. The point is, in real life, we don't have that knowledge. So what we do is, using the risk-adjusted approach most of the time, and in the world of auction, in the world of derivative pricing, we have other type of arguments that allow me to recover these probabilities. The point is, if you can use certain additional information or certain conditions which allow you to recover the Q probability, then wouldn't you be able to compute this expectation under Q and then discount under risk-free rate? And the answer is yes, and that's exactly what we do when we do derivative valuation. So there are just two approaches. Most of the time, risk-adjusted approach. Derivative pricing, risk-neutral approach. Okay?
So in derivative pricing, if you find Q, lowercase q, the meaning of lowercase q is like probability you give with risk aversion or not?
It's a kind of,
What's the meaning of Q?
it will be impounded in prices, it will be impounded, it's like his risk adverse. I'm not saying his risk neutral, his risk adverse. But I'm taking an argument based on the knowledge of his certainty equivalent to construct risk neutral probabilities and make a valuation that yields exactly the same value that discounted at a risk-adjusted approach.
So the Q is a risk neutral probability.
We call it risk neutral probability because we can discount that. Why is it called risk neutral? Because we are entitled to use the risk-free rate only for that reason. And the risk-free rate is the only one that can discount at the risk-free rate is a risk neutral guy. So because we are discounting an expectation with risk-free rate, we call it the risk neutral approach. But it is not kind of magic, or I'm not making out anything. It's just using mathematical tricks. Use a condition here, knowing that he's willing to take 6,000, and infer the probabilities, and then you see, mathematically it will be the same. And because I'm working with an expectation, a weird expectation, it doesn't exist in reality, it exists in this mathematical world that we call the risk neutral world. It's not a real world, but if you want to do derivative valuation, the funny thing, the most striking thing, what bothers people a lot at the very beginning is you will not use the real probabilities. You will use something that we call the risk neutral probabilities, and that's super confusing. It's like why the heck? Because we are using this type of mathematical tricks. I'm using information that comes from certain conditions, and those conditions reveal me the probabilities, and then I do the job.
You said like in reality, only 2 and 3 we use, right?
Yes, only 2 and 3 are used.
And one is the risk adjusted approach, and the other
Yes.
one is the risk neutral.
That's risk adjusted for everything,
Corporate finance, and the other one for derivatives.
and for derivatives is neutral because it has more natural advantages. Okay, guys. So let me review this very quickly. Certainty equivalent, like I said, just is the theoretical reference for us. If we knew the certainty equivalent, we'll be happy. Problem is, how the hell do you expect to get this knowledge in real life?
It's impossible.
It's impossible. There are certain papers that do this thing, with limited populations. For instance, master students. Let's confront it with this game. Imagine that you have a game that pays 3,500 minus 3,300 and minus 16,000 with those probabilities. How much is your certainty equivalent? How much is the amount
0.
that you will be willing to pay? Some will say 0, some say other amounts. The willingness to pay of American students on average was $320. They all are risk lovers. everyone that said something that is not zero was risk loader. They all are risk loaders. That's why we said it's kind of tricky, but they say risk loaders. But see how the difference is, right? American students and German students pretty much the same. Polish students much more risk adverse. All of them risk loaders, but these guys were kind of more willing. You know, they demanded more. And Chinese, they are the ones that demanded the most, because they are the most risk lovers of all of them. The more tolerant with risk are those Chinese people, because culturally they like gambling. Am I right?
I don't see.
I don't mean you're gonna go to the casino, but it's not unusual to see. They say, for instance, this offers to in the tourist. I come from Alicante, and it's a very touristic place, and we have a lot of Chinese people coming. And they say the Chinese customer likes spending things in like a luxury, so they are they save a lot. But when they go abroad and when they go in tour, when they go in travel, it's like everything's good, and they spend a lot of money in luxury things and gambling. They put tours, and then we go for casino or we have a stop. This is what they say. I don't know.
Macao, casino.
That's what they say.
La ciudad de casinos de China. Ya, ya.
The point
Es
is,
una ciudad en la que todos se
the point, guys, is that unless we were sort of making those surveys systematically, we will never know what the certainty equivalent is. So instead of that, we work with adjusting the discounted factor, and that's the most common approach, except for derivatives. And in derivatives, you will never observe anything that is not a risk-free rate-based discounted factor. And that's possible because you are treating the probabilities building on those different sets of probabilities, right? The Q probabilities. Now let me give you a few insights. How much are still time?
Can I ask you something?
Right.
I didn't understand the P and the Q
Measures.
the put over the expected value.
P, you understand P, right?
Oh no.
P is the natural one. You have 4,000 with probability 50%,
Wait.
10,000 with probability 50%. So the expectation of that, 50% of the time you make 4,000, 50% of the time you make 10,000. On average, 7,000.
P is the natural.
The natural one. We call it the real one or the physical one. Okay? And now Q does not exist. Q is a different thing. Q is something that we can construct under certain conditions, certain additional information that make us essentially make us infer the certainty equivalent.
Okay.
So put it in these terms. I asked Jesus, what is your certainty equivalent? He told me 6,000. Now I take this knowledge and I say, if I want to do expectations and to make that thing equal to 6,000, it's impossible if you use the real probabilities. With the real probabilities, you get 7,000. You will never get 6,000 in expectation unless you change the probabilities. We cannot change the outcome. The outcome is 4,000, 10,000. But I make out these fake probabilities. What if I compute this expectation with a probabilities which are 2/3 for 4,000 and 1/3 for 10,000? Then the expectation is 6,000, which is the second equivalent. And if you discount that 6,000 with the risk rate, you get the fair value. So we call this approach the risk neutral approach. So the point is getting those risk neutral valuation. Next day, I will give you an example of that. It is you're gonna see this in greater detail. It's called the binomial model for valuing options. You're gonna see it in finals 2. This is complicated, so I'm sort of helping my colleague introducing the concept. I'm not interested in the option. I'm introducing in the idea that risk neutral valuation means. So I'm gonna sort of discuss this model, and we're gonna sort of identify which extra conditions do we need in order to identify those set of probabilities. And those set of probabilities can be identified as long as you claim there is no opportunity, there are no arbitrage opportunities. So the no arbitrage condition gives me risk neutral probabilities, and that's sort of fun. It was brutal. One of these three guys, this is called the Koch-Ross-Rubinstein.
The main guy here, in all this neutral approach, this arbitrage, whatever, was called Ross. Ross is one of the most, to me, underrated ever. I mean, it's so unfair that this guy was never given a Nobel Prize. When you see Nobel Prizes in finance, you see Restas Fama, it's like, you see, I don't know, Engel, it's like, oh, come on. Sharp, you see the proof of Sharp, and it's like, I can't believe this is a Nobel Prize of finance. This guy made a massive, massive contribution. This model is still taught in all the master programs in the world, and he didn't get the, I mean, it's like anything else. You see why this is Nobel Prize and this not. Sometimes it's, you know, like a marketing, sometimes it's like isolated to many factors.
Sometimes it's low.
Yeah, exactly. This is just like that. So this guy, Ross, never got a Nobel Prize that everyone in the field, everyone in the academy agreed he had he will be well deserved. So I'm going to present this model in order to make this thing a little more transparent, more clear, because I'm well aware that this neutral thing is the most striking thing. People hate derivatives because the barrier, the cost of entry is huge because of these concepts. And it becomes so unnatural that people are like, oh man, I don't understand it. It's super mathematical. It's super weird, right? You're not working with the real probabilities. But if you want to use this in practice, you need to understand that. We will not use real probabilities in derivative pricing. Whether the market goes up or down, probably 80% of 20%, that information is not used because you are using the risk neutral approach. That information is useful when you are using the risk adjusted approach. 80, 60, 50, 50, and you make the expectation, and then you need to pertain the prices, then you need to figure out what the proper discounting factor is. We will discuss that in chapter 2. Okay guys, let me finish today's class with evidence supporting these things, right? First of all, it's a version, right? This return that has a positive thing. Those are 10-year bond yields. Remember, if you click those graphs and you see that the hand is changing, that means that some hyperlink is working. So those show you what is called the risk premium in the term structure. Yep. Yep. So for instance, for Europe, the reference is Germany. We use in Germany the 10-year bond.
For you.
Huh?
O sea, for the Europeans, you mean?
Yeah. For European, well, this is AAA. Germans right now have greater credit worthiness than the US.
Americans,
Yes.
Both.
Canada has their credit worthiness than the US. The US has no longer AAA.
I mean,
No longer. Huh? They lost it first time. They lost it before financial crisis. There was no market speculating with the possibility of the US going into the banking crisis. There was no market for the CDS, a swap, a derivative which sort of protects you against default in the bond in the US bond. After the crisis, they are sort of moving, but right now it's double A plus, no longer triple A. So this is the 10-year bond. Why 10 year? 10 year because it's long-term bond. So you sort of see long-term perspectives, something that goes just immediate, maybe very market-driven. 10 year is kind of long-term. Why not longer than 10 year? The reason is that investors like a lot the 10-year horizon. You go into the 30 year, that's really looking forward, right? But it's so illiquid that the premium is going to be higher. You don't see just default premium. You see liquidity premium. If no one trades with a 30-year bond and has very thin market because people dislike that horizon, they perceive it as too long, right? In 30 years, many things may happen. So 10 years is the favorite horizon when it comes to fixed income. Long term, but not too much long term. And what you see is how much does the yield. If you invest over the 10 years, the Germans will pay you certain amounts periodically every year over those 10 years, and that makes the whole investment at 2.627%. That's the yield to maturity. It's the promise. If they pay what they say, you compare what you invested in this bond with which much you get on return, and that's at 2.62%. And that's the reference. That's for instance for the Germans. Now look at the bond, the Spanish bond. We have a yield which is greater, 3.16%. This is a risk premium. The difference, we call it, sorry, I changed to Spanish. In the Spanish media you hear it very often, the prima de riesgo. The prima de riesgo, whatever you see, you hear that in the Spanish news, it's referring to the spread between the 10-year bond, the Spanish 10-year bond, and the German 10-year bond. And that difference is measured in what is called basis points. So we have something like a 50 basis points, which is a kind of hawkish range. In the crisis in 2012, it was called 600. It was brutal, and it was too much. It was not based on, it's just what we said before, a lot of speculation, a lot of things going and thinking. People essentially, for you may be surpassing right now because you were too young at that time, but in 2012, there were people believing and betting that the euro would fall. People believing that the European Union would collapse. And we see that, and if that happened, it may happen, and it may be even worse in some moment in the future. But in 2012, there were people making bets to the fact that the market could go down, the European Union could collapse. Because it was not prepared, a lot of reforms took place after that, but this premium was high. Why is so interesting to compare those things? Because we have the same economic area, we have the same currency. Those euro related, those are euro denominated bonds. So this difference is just about the perception of risk. People who buy the Spanish bond perceive greater risk than people buying the German bond.
So people perceive less risk in China than the States.
But then there is a trick. Is what I say. Here the comparison is straightforward because we have the same currency. If you go to the US, you're gonna see something like a 4 something. And you then if you take this comparison at face, it will be tempting to say, oh, so the US is worse than the Spanish, right? 3.99 is like a 4%, whereas the Spanish are paying 3.16%. Yeah, the Spanish are paying in euros, the Americans are paying in dollars, and that makes a conversion factor. You need to take in these international factors, you need to take into consideration that thing. You go to Brazil, Brazil is paying a lot. Why? But they have a massive inflation. I mean, Argentina is not reporting anymore. Venezuela is not reporting. They simply are out of the market. They are not reporting. Not Argentina is here, right? No. Before saying with this big mouth open. So they like just American. Sorry, this is just objective analysis.
Well, that's risk-free.
No, so no market at all for this. They are out of the market. Argentinians last year,
0% is the same.
Argentinians were paying like a 40% last year. I remember 40, massive. Right now are out of the market. 40%, why 40%? Because they have investors facing inflation.
Yeah, actually they were like also converting a lot of super short debt in something a little bit longer.
Not to mention that not to mention that the longest term was like 5 years. No one.
And most of their debt wasn't like, when Milei arrived, it wasn't like 1 day, 1 month.
Yeah.
It was like most of the Argentinian debt.
They are now getting financed through this swap with the US, which is kind of super agreement that he got, and he's sort of going into this circuit because they don't have access to international funds. So you see this premium, and what we learn in here is like that, right? Why? See, why? I don't know, right? After accounting for that, you see, for instance, like the Greek used to pay a lot. Right now they are doing very well. Surprisingly, the very surprise comes to France. They are paying 3.43. You compare that to Portugal, which is 3.01. The Portuguese are paying for the debt less than we do, which is almost an insult. Sorry, this is very much this idea. Portugal is 10 million population. The GDP of Portugal is the same size than Madrid. They are perceived as less risky than the Spaniards. So this is an insult for us because it is what we deserve. These guys, the Portuguese, did the homework, we didn't.
I have some friends that say this is the good things about being intervened. You know, when the wildfire destroys things, yeah, but after that, in the aftermath, things paradoxically are better. Because we were not intervened officially, we still have these kind of structures, these things weird, and we are paying a sort of political premium. That thing happens to the French. Bigger size. People, investors, perceive the French economy as more disturbed, as more distorted than the peripheral economies that traditionally, like Greece, Spain, Portugal, have traditionally had bigger premiums. You can see that in the financial market, but you can see these premiums, the systems of these premiums, also in other markets. You can see if we compare in the stock market different classes of stocks. You go to large stocks and small stocks, and common sense would say, you know, small firms have more complicated conditions, they cannot sort of access to the same funding conditions, so you observe greater risk reflected in a premium. It's not the same investing on stocks than investing on treasuries. We see the risk premium embedded in the stock market, huge risk premium. So large that our models, our macroeconomic models cannot explain. So this is called the equity risk premium puzzle. In order to explain all this big gap, and you go to the traditional utility functions with this gamma coefficient, you need a super large gamma coefficient that simply makes no sense. So traditional models were sort of criticized, saying, you know, if you expect a constant relative risk aversion coefficient of around 3 or 4, you should not observe this huge gap between the yield of the stock market and the treasury market. The gold market, commodity, is something like a 5%, real estate is like a 4%, treasury bills are 3%, longer term markets are like a 4.5% in the US. So you see those differences, all of them are risk premium. The most, traditionally, the most speculative investment was the stock market. And what we do in our models is to consider that this risk premium, this delta, comes from the exposure to a number of factors upon which you demand certain risk premium. So we're going to discuss in chapter 2 the most well-known models that build on this structure in order to give you this delta. You can price things when you have the correct risk return, and that comes from what we call asset pricing models, such as the CAPEM or the Fama French models that build on this structure. The expected return has risk-free rate plus premiums that come from exposure to different risk factors. And whether you consider a single risk factor or multiple risk factors is what determines the model that you are working on. For instance, the CAPEM has just one single factor, which is the market. We measure that with this thing that we call the beta, and we have an equity risk premium, which is around 5%. So the CAPEM model is super simple to be implemented because you can calibrate the beta coefficient by relying on observable information. And I'm going to show you to do that. In chapter 2, we will work with real data to get those betas and figure out what the cost of capital or the expected return of, for instance, IBM should be given the current value of that beta coefficient, according to the CAPEM model. Okay? So next day, on Monday, regular timing, I will sort of finalize this idea with the risk-neutral approach, building on this setting. We're going to discuss this model. Instead, you're going to see this model indeed in Finance 2, the next course, but I want you to show the conceptual thing. You will see that in the context of risk management. My interest is understanding what this exotic thing is. And I'm well aware that it's kind of weird. What the hell? No, for everyone, not just for you. But it's super beautiful. You understand? It's like, how someone will figure out this. And make a model, Black-Scholes model, which is neutral. The binomial model is neutral. Go guys. No, pero es que va. ¿Cómo estás? Soy súper
para eso, pero es un dentro de la tecnología de los modelos es una cosa, o sea, increíble. En el sentido de decir, mira, no es que son unos modelos